Hello everyone, welcome to another video for CFA Level 1. In today's video, we will be doing two important topics that will be capital asset pricing model and security market line. Both the topics are interrelated to each other, so it will be better for you guys to study it together and understand. Okay. Capital asset pricing model is one of the return model. So if you remember in the previous class, we had done three return models: single index model, return generating model, and the multi-factor model. Okay. Capital asset pricing model is a kind of single index model, okay, but with specific limitation, but with specific assumptions. Okay, so basically in capital asset pricing model, it is primarily saying that my returns expected will be based on number one, the systematic risk that I am taking, okay, which is denoted by beta. Okay, over and above of the market risk premium. Okay, so basically what capital asset pricing model is saying, capital asset pricing model is following the capital market theory and saying us that the return that an investor should expect should not be based on total risk. Okay, first of all we need to make this fact very clear. An investor need to expect return only based on the systematic risk. Point number one. Point number two is that the return that a investor can expect to make from the portfolio, the factor which is influencing it will be the market return. Okay, there will not be multiple risk factors, right? Like in the single index model, there were multiple factors, right? Sorry, in the multi-factor model that we have seen, there had multiple models. Over here, we are not saying there will be multiple factors. There will be a single factor. Okay, and that factor is the market. Single factor, and that is a market factor. Guys, are we clear? Guys, I hope. And guys, you need to understand capital asset pricing model. Why? Because it is the most widely used. It is the most widely used concept when we need to determine the expected return on an equity security. So most widely used when we want to determine expected return of equity. Very important because this model is very widespread. Okay, so it is used when we need to determine the expected return of the equity. Okay, let us see what this formula is saying. Let us try to understand the formula. What does the formula is saying? Formula is saying that the expected return of the security or the expected return of the portfolio is nothing but risk-free return plus market risk premium. What is market risk premium? Market risk premium is nothing but the excess of return of the market over the risk-free return. So this is market risk premium. Market risk premium. Okay. RF plus RM minus RF. Okay. Into beta of the portfolio. Into beta of the portfolio. What is beta? We all know. Beta is nothing but the systematic risk of portfolio. Guys, are we getting it? Beta is nothing but systematic risk of the portfolio. So if you look at it, my return on the portfolio is nothing but my systematic risk when applied on my measure of systematic risk when applied on the market risk premium. Are we understanding the fact? Guys, are we understanding the fact? Beta of the portfolio applied on the market risk premium. Simple as that. This simple looking formula has widespread application on the entire field of finance, especially when you're talking about equities. Are we clear, guys? Okay, let us read what it is saying. Let us read. It asserts that the expected return of the asset varies only by their systematic risk and measured by beta. So, what it is saying, systematic risk is the sole factor. Returns based on systematic risk. Okay, and not total risk. Guys, very important to understand. Guys, very important to understand. Returns based on systematic risk and not total risk. Guys, you need to understand. Returns based on systematic risk and not total risk. Okay. Two assets having the same beta will have the same expected return irrespective of the nature of the two assets. Again, a very important point. So what it is saying that if I have two assets, okay, and both of them have the same systematic risk. What do you mean by systematic risk? Systematic risk is measured by beta. So if two assets have the same beta, okay, so basically same systematic risk, same systematic risk, then we can say that as per CAPM model, what is CAPM? Capital Asset Pricing Model, their expected return. See, we have to understand over here. We are not talking about actual return. We are always talking about the expectation. See, actual return can be anything. Okay, actual return can be lower than the expected return. It can be higher than the expected return, or it can be as same as the expected return. Okay, but whenever we are understanding or reading these models, one thing has to be noted that we are always talking about the expected return. So what we are saying that if two assets have the same beta means same systematic risk, then their expected return, irrespective of their asset, irrespective of the nature, will be same. Okay. However, see, now it is very important. It can also come in as MCQ. CAPM model. CAPM model is based on certain assumptions. Okay. And guys, you need to understand these assumptions are very important because if these assumptions were not taken, okay, then the CAPM model itself doesn't hold. So, in order to ensure the validity of the CAPM model, these assumptions are important. Okay. In risk averse investor, not this is not adverse, this is averse. So what we are saying, the first assumption that we are making is that investors are risk averse. Guys, we have all read the different categories of investors: risk averse, risk seeking, and risk neutral. So it is saying that investors are assumed to be risk averse. What is risk averse? Which means they dislike risk. Okay, fair point. Second point, utility maximizing investor. What is utility maximizing investor? It is saying that investors want to maximize their investment utility. What does it mean? It is basically meaning that investor wants to maximize their return based on the given set of investment, based on the given availability of their risk to be taken. Okay. Third, markets are frictionless. What is frictionless market? It is basically saying that transaction costs are not there, taxes are not there, so on and so forth. Basically, it is saying that the market, again, this is saying, this is relates to a point that Diversification is free of cost. Free of cost. Okay. The next point is homogeneous expectation of investor. Guys, I hope you remember this homogeneous investor expectation point. What does it mean? It means that as an investor, my expectation from my investment will be same as that of the other fellow investor. Okay, with respect to the risk we are taking and the returns that we are getting. Okay. Assets are infinitely divisible. Yes, assets are infinitely divisible. Investors are price takers. Yes, investors are said to be price takers. They do not dictate the price. And the last is markets are competitive. So the chances of mispricing and all is not there. So basically, we are saying that expected prices will reflect in actual prices. Are we clear? Guys, so with this we are done with capital asset pricing model. Was a small topic but an important topic for you to understand from an importance point of view, from an entire thought process point of view. Okay, now we come to security market line. Very small topic again, but very important. Let us see what it is saying. Security market line is nothing but a graphical representation of CAPM model. Okay, so guys, we know that any equation, okay, can be graphically presented. So basically it is a graphical presentation of CAPM graphical presentation of CAPM model or CAPM equation. Guys, are we understanding it? It is a graphical presentation of the CAPM equation. Okay, that is reflecting on the systematic risk on the y-axis and expected return, or sorry, systematic risk on the x-axis, expected return on the y-axis. So see, in the y-axis I have expected return, in the x-axis I have beta. So what does it say? It is basically y is equals to rf plus x, rm minus rf. Okay, what is this y? Y is nothing but the expected return, x is nothing but the beta. If we consider rf to be a and rm minus rf to be b, so we can say this is nothing but y is equals to a plus bx. This equation is nothing but a plus bx, where a is equals to rf and b is equals to rm minus rf. Guys, are we understanding it? Okay guys, cool. See what it is showing. See what it is showing. It is saying two things. At this point I have zero risk and zero return. Okay, as I move to the y-axis, okay, as I am moving to the y-axis, I am moving upwards in the return hierarchy. Okay, I am moving upwards in the return hierarchy. Suppose at this point, point A, I am at risk-free return. Suppose at point A, I am at risk-free return. Okay. Suppose at point B, I am at market return. Point B, I am at market return. Okay. So basically, the way your CAPM equation works is that it is a straight line, upward moving straight line. Okay, at a point where your systematic risk is 1, at a point where your systematic risk is 1, which means x is equals to 1, you will see, you will reach to a point where your expected return at that point is the market return. So suppose for an example at point C, you can say beta is equals to 1 and uh, expected return equals to market return. Correct. Suppose if you go upwards, what you will find? You will find a beta higher than the market. you will find a beta of the portfolio higher than the market beta. In that situation, what will happen? The return that you will get, the return for the portfolio that you will get, will also be greater than the market return, guys. Are you getting it? The return that you will get will also be greater than the market return, guys. So basically, what it is showing is that starting from the risk-free return, we can reach to a point where your systematic risk is 1 and your returns are equal to the market returns. And beyond that, when you go, your portfolio returns because you are taking more systematic risk. See, since my systematic risk is more than the market risk of the market, my returns from the portfolio is also increasing. Okay, guys. Now, see, we have, if you remember, we have studied about two lines. One is capital market line, second is SML, correct? And there are chances that you might also get confused. So the primary difference we have stated over here in CML, in capital market line, okay? In the capital market line, the expected returns were determined by standard deviation. What is standard deviation? Measure of total risk. Okay. So basically, when we were drawing the CML, the factor which was impacting the returns was total risk. Similarly, when we are drawing the SML, securities market line, the factor which is determining the expected return is the beta or the systematic risk. Are we clear? Again, we come to the assumptions of CAPM and SML. CAPML and SML gives an indication of what return in the market should be given a certain level of risk, correct? They will give me the return expectation based on risk. The only difference is for CML, it is the total risk. For SML, it is the systematic risk. This is a very important line, guys. The actual return will be quite different from the expected return. This is what we were discussing a few minutes ago. Discussing few minutes ago. All the models that we have studied, guys, you need to understand, they will only give me expected return. The actual return can be different. Are we clear? Final certain application areas, definitely capital budgeting. How capital budgeting? When we do the topic of capital budgeting, we will look into it. Comparison of actual return of a portfolio or a portfolio manager with the CAPM return for performance appraisal. Now, what is performance appraisal? Performance appraisal is again something which we will study in the later topic. Okay. But for glimpse, performance appraisal is basically something where you compare the actual with the expected return in order to determine how the portfolio manager has performed. So, for example, if my expected return was 10% and actually I got 12, so which means that my actual performance has exceeded the expectation. So, whether will you call that manager good or bad? Yes, prima facie he is good. Similarly, if my expected was 10 and the actual is 9, can I say he was not good? Prima facie, yes. Similarly, if my expected was 10 and my actual is 10, can I say he is satisfactory? Basically, he is meeting my expectations? Yes. So that is primarily performance appraisal. But performance appraisal in deep, we will see in further topics. So, guys, with this, we have come to the last topic, performance evaluation. We will we will do this topic in the next video, guys. Till then, happy studying and thank you.